Hello, everyone. Thank you for joining our webinar today. I'm Lene Mellegard, VP of Marketing and Studio at Volusion. For today's webinar, we're really excited to have John Whiteknight, one of our partners at Avalara, here to talk about tax changes occurring in 2022 and their effects on e-commerce businesses. We'll also be sending a recording of this webinar to everyone tomorrow afternoon in case you don't have time to listen today or you have to drop off early. John, I'll go ahead and hand it over to you.
Thank you, Lene. Hello, everyone. My name is John Whiteknight. I'm a sales manager in charge of our core emerging team here at Avalara, and I've been helping companies automate the complexities around sales tax for about 5 years now. Avalara has been tackling the problem of sales tax compliance for over 17 years, and we now serve over 40,000 customers globally with more than 1,000 pre-built integrations into the major e-commerce, ERP, CRM, billing, POS, and accounting systems. We serve customers from 95 countries and have over 3,300 employees globally with offices in 12 countries. Today, I'll be walking you through the state of commerce, new e-commerce tax obligations, South Dakota versus Wayfair, economic nexus, how states are running virtual audits, remote workers nexus, selling on marketplaces, and finally automating all of these crazy processes. I'll start out by covering the state of commerce, which has shifted significantly over the course of the pandemic and even in the past 12 months. The first point we want to highlight is that in Q3 of 2021, 1 out of every $6 spent on retail purchases came through a digital channel. This is a pretty big shift as we've seen a lot of shopping behaviors moving from in-store. A lot of these changes can be attributed to restrictions that were in place during the height of the pandemic, but not all of them. That leads us to our next point, which is that in Q2 of 2021, we saw the highest year-over-year growth all retail sales at $1.13 trillion. This includes both online and in-store selling. So even as the pandemic pushed more shoppers online, brick and mortar sales as once restrictions were lifted. This is also a reflection of a lot of businesses expanding their footprint across the country and even across the globe to reach more shoppers. Then finally, we can see that 96% of mid-sized companies have implemented some kind of change to their business as a result of COVID-19. For many businesses, this was moving from brick and mortar to an online or omni-channel approach. For businesses already in the digital space, this included investing in automation, digitization, and more to improve the customer experience and streamline the business. So this leads us into what these changes in commerce mean for tax obligations for businesses selling online. As online sales have increased, more attention is being paid to the way taxes are collected online through what is known as economic nexus. Economic nexus is a concept that allows U.S. states to impose sales tax on businesses that sell within that state, even if the business is not physically located within the state or even the country. This is due to a Supreme Court case from 2018 known as South Dakota versus Wayfair. Now for some context. Prior to this court case, guidance was established as far back as 1967 that businesses selling through mail order were not required to collect sales tax in the state they were selling into. This was originally meant to be more of a guidance, but was widely adopted as standard. Because of this, physical nexus laws became the norm, wherein sales tax was only charged in states you had a physical presence in and was imposed with your first sale. The South Dakota versus Wayfair case took into account the change that the internet brought to the way products are being bought and sold, and allowed for economic nexus laws to go into effect. With economic nexus laws, businesses must charge sales tax in a state once they surpass the minimum threshold of sales for that state. which at the time was $100,000 or 200 transactions. As of today, 45 US states plus Washington, D.C., Puerto Rico, and different cities throughout Alaska have economic nexus laws in place. But as you can see from this map, once states realized they could impose their own sales tax rules, a lot of them created their own thresholds rather than sticking to the $100,000 or 200 transactions concept. And it's important to note that the court case made it the business's obligation to know what these thresholds are by state and adhere to them rather than the state's obligation to notify them. Because each state is going by its own rules and those rules are changing constantly, it's extremely difficult and time-consuming for businesses to keep track of every requirement from every state. And it's important to note that economic nexus doesn't just stop thresholds. Each state's law have their own layers. For instance, in South Dakota, religious entities are exempt from paying sales tax on online purchases. However, in North Dakota, they are not. So once a business has passed the threshold for a state, they are required to register and begin collecting, remitting, and filing sales tax in that state. Now, you're probably wondering how long the obligation to pay sales tax to the state lasts once a business has established economic nexus. Unfortunately, again, this varies from state to state. But in most cases, businesses that fall below the threshold can notify the state in question and deregister from their obligation. Some states require businesses to remain registered for a set amount of time after they have fallen below the threshold, while some states let businesses deregister immediately. Another thing you may be wondering is how states themselves can keep track of all this unless they are notified that a business is not adhering to economic nexus laws. And the answer here is audits. In the past, audits relied mainly on state treasury workers traveling to businesses to physically audit their sales. But of course, with the move to digital connectivity for just about everything, this practice has all but ceased. And as the pandemic pushed more people to work remotely, that accelerated the move to virtual or desk audits, as they're sometimes called. With virtual audits, states can simply electronically request sales and tax filing information from businesses rather than having to travel there to review statements in person. This reduction in travel, in turn, allows states to perform more audits than they were previously. While the pandemic was at full force, most states stopped performing audits from April 2020 to around mid-2021. But at this point, virtual audits are back in full swing. And as state governments have tracked that huge increase in e-commerce and are always looking for new revenue, they are more likely to look into what businesses their residents are purchasing from and making sure they can collect as much of the taxes they are owed as possible. Moving away from economic nexus laws briefly and back to physical nexus. Another thing that the pandemic has changed is the location of workers for many businesses. A lot of business owners have outsourced some of their jobs to other states, and a lot of workers have moved to other states because they can complete their work remotely. This shift has implications for businesses' taxes as well in the form of physical presence nexus. A general rule, businesses have physical nexus in a state if they have offices, inventory, or workers in that state, which means they must collect sales tax in that state regardless of their economic nexus status. Some states have different laws about what types of workers count for physical presence nexus. In general, the rule tends to be that if the worker helps a business create a market in that state, then they have a physical presence in that state. Whereas a worker like an IT person who does not have an effect on creating a market doesn't count. These rules also vary by state. Because of the pandemic, some states exempted remote workers from establishing Nexus for a while to ease the burden on businesses. But just like audits, at this point, most of the exemptions have expired and remote workers are again considered for physical presence Nexus. Now I'd like to segue into a topic that doesn't apply to all e-commerce businesses, and that is collecting sales tax on products sold through marketplaces. This is still very important information for anyone who is planning on selling on marketplaces in the future, even if they don't do so right now. So let's take a second to define exactly what we're talking about here. Legally, a marketplace is a physical or electronic place where tangible goods are sold. The marketplaces most commonly used by e-commerce businesses that are taking on an omni-channel approach to selling online are Amazon, Etsy, and eBay, with many industries having their own versions of marketplaces to sell products through. A marketplace seller is a person or business that sells product through a marketplace, while a marketplace facilitator is a business that contracts with third parties to sell products on marketplaces. So Amazon software is the marketplace itself, and Amazon, the company, is the marketplace facilitator. Marketplace facilitator laws have been enacted across almost every US state, with Kansas, Florida, and Missouri implementing their own within the last 12 months. The good thing for businesses selling through marketplaces is that marketplace facilitators are the ones with the obligation to collect and remit sales tax on behalf of the business or individuals selling through them. However, that doesn't completely eliminate the sales tax burden on businesses selling through marketplaces. For example, sellers who store inventory in a marketplace facilitator's warehouse in a different state establish physical nexus in that state. And even though the marketplace facilitator is on top of enforcing sales tax correctly for each buyer, businesses are still responsible for reporting sales tax collected and remitted through these marketplaces on their tax returns and reports. As selling through marketplaces continues to increase in popularity, tax laws in reference to marketplaces will also change. So how do businesses like yours keep up with sales tax laws that differ from state to state and are constantly changing? Many online businesses are turning to automation tax software to keep up with sales tax laws and ensure they remain compliant. Avalara is an industry leader in tax automation and helps businesses of every size stay compliant. Automating sales tax management not only helps ensure tax accuracy, increase efficiency, decrease risks, but it also allows you to set it and forget it, giving you time back to focus on growing your business. And that about does it for me in my presentation. Thank you so much for tuning in. We'll also provide a few links to some helpful tools like our free sales tax risk assessment. Additionally, if you want more in-depth information about anything we've talked about today, you can check out the 90-minute version of this webinar over on the Avalara site. We will include a link for you to check that out if you're interested. The extended version also touches on a few other topics, such as the impact of supply chain and labor shortages on taxation, international tax compliance, and e-invoicing. Again, thank you so much for checking out this webinar, and I will go ahead and pass it back to Lene.
Thank you so much, John. Definitely some great information to have as we enter the new tax season. Again, we'd like to thank you all for attending this month's webinar. If you're interested in watching again or you missed any portion of it, we'll be sending that video link to all of you in about 24 hours, so you can review it or bookmark it if you want. Thanks and have a great rest of your day.